The first week of 2026 exposed something critical about market psychology. While the S&P gained 19 basis points on Friday, the Santa Claus rally failed completely. The Dow climbed 66 basis points, but the Nasdaq went nowhere. When seasonal patterns break down this decisively, the system is telling us something important about human behavior under stress. Here's what most traders missed. The Venezuela military intervention should have triggered classic flight to quality moves. Instead, gold surged above $4,400 while Treasury yields climbed. The 30-year hit its highest level since September. This inversion reveals that inflation fear now dominates recession fear in the collective mind. Investors are pricing regime uncertainty, not just policy risk. The semiconductor rally tells a deeper story about late-cycle psychology. Micron hit all-time highs with a 7% surge. Intel jumped 7%, but Microsoft fell 2%, and Tesla dropped over 2% after missing delivery targets. The market is bifurcating between AI infrastructure plays and overextended growth narratives. This differentiation process signals the end of indiscriminate tech buying. The human layer shows exhaustion masquerading as stability. Bitcoin anchored near $88,000 while the fear and greed index sits at 34. This isn't strength, it's paralysis. Participants are waiting for macro clarity before committing fresh capital. The absence of panic doesn't indicate health, it indicates a system in transition where conviction has been replaced by conditionality. Now here's where the system layer becomes exploitable. Bond markets transmitted the clear signal of the week. When duration gets repriced higher despite geopolitical shocks, the market is telling us the Fed's dovish pivot is over. There's only a 50-50 chance of a March rate cut. The system is recalibrating around higher for longer rates, which cascades through equity valuations via the discount rate mechanism. The commodity complex revealed institutional positioning shifts. Gold rallied alongside a strengthening dollar, breaking the traditional inverse correlation. This happens when confidence in central bank credibility erodes. Silver jumped 3% on Sunday. Aluminum crossed $3,000 per ton for the first time since 2022. These moves reflect portfolio insurance demand, not speculation. Sector rotation exposed the AI trade's internal contradictions. The Magnificent Seven declined 1% while semiconductor infrastructure plays surged. Capital is now demanding proof of concept, not just promise. The era of narrative-driven buying has ended. This creates opportunity for disciplined investors who understand the difference between infrastructure beneficiaries and companies whose AI stories haven't translated into earnings. The geopolitical shock introduced a new volatility surface that option markets struggled to price. Defense stocks rallied while oil remained stable, suggesting contained intervention rather than systemic risk. But the combination of military action, Greenland rhetoric, and unpredictable tariff policy creates regime uncertainty that traditional hedges cannot fully absorb. Here's the stoic response to this environment. Extended bull markets don't end with clarity, they end with confusion. The divergence between indices, breakdown of correlations, and failure of seasonal patterns all point to a system in transition. This isn't the time for conviction trades based on momentum. It's time for process, position sizing, and patience. The December jobs report this Friday becomes the critical inflection point. A strong print validates the no-landing scenario and forces further bond repricing, compressing equity multiples. A weak print revives recession fears and may force Fed dovishness, providing temporary relief while confirming labor market deterioration. The disciplined approach doesn't position for one outcome. It structures exposure to benefit from volatility in either direction. When bonds and equities decline together, when gold rallies with the dollar, when small caps surge while large caps stagnate, traditional portfolio construction fails. The system is revealing its fragility through the breakdown of diversification. This requires adaptation through increased cash allocation, shortened duration, and focus on asymmetric opportunities where downside is defined and upside is uncapped. The first week of 2026 didn't provide answers, it provided questions. The market that answers those questions will look different from the market that asked them. In a system transitioning from momentum to mean reversion, survival becomes the prerequisite for opportunity. The disciplined investor doesn't need to predict direction, only to ensure that positioning allows exploitation of the move rather than being exploited by it. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit human predictability. Download the complete Stoic Exploiter methodology in the description, because markets reward discipline, not speculation.